Let's talk about investing. More specifically, let's talk about how to invest intelligently. Investing isn't about chasing trends or timing the market. It's about understanding fundamentals and making smart decisions. One name stands above the rest: Benjamin Graham. Graham, the father of value investing, wrote the book on intelligent investing. His masterpiece, The Intelligent Investor, is the investor's Bible since 1949. The Intelligent Investor is not just a dry textbook filled with financial jargon. Graham uses clear, concise language that anyone can understand. He explains complex concepts in a way that resonates with both seasoned investors and those just starting. He uses real-world examples to illustrate his points and make the information relatable. This book has stood the test of time for one simple reason: it works. The principles Graham outlines have been proven to generate consistent returns over the long haul. Countless successful investors, including Warren Buffett, credit Graham with shaping their investment philosophy. In fact, Buffett has called it by far the best book on investing ever written. Whether you're a beginner or a seasoned pro, The Intelligent Investor has something to offer you. It's a book you'll return to again and again throughout your investment journey. It's a source of wisdom that will help you navigate the ups and downs of the market. In this summary, we'll break down the key takeaways from The Intelligent Investor into bite-sized pieces. We'll explore the core principles of value investing, understand how to analyze companies, and learn how to protect your investments from unnecessary risks. You'll learn how to make informed investment decisions and build a portfolio that aligns with your financial goals. Think of this as your crash course on becoming a smarter investor. We're going to equip you with the knowledge and tools you need to take control of your financial future. Investing doesn't have to be intimidating or complicated. With the right guidance, anyone can become an intelligent investor. In the world of investing, there are many strategies. Some chase short-term gains, hoping to get rich quick. Others follow the crowd, buying what's popular. But Graham teaches value investing. It's about finding undervalued companies, like shopping for a sale. You're looking for quality at a discount? This approach requires patience and a long-term perspective. The market often misprices assets, but value investors reap rewards when it corrects. Section 2, understanding intrinsic value. How do you determine a company's intrinsic value? It's not about the current stock price. Intrinsic value goes deeper. Analyze financial statements, understand the business model, and assess future earnings. Look at assets, earnings, debt, and management. Understand the industry and competitive landscape. It's like doing your homework before a big purchase. You wouldn't buy a house without an inspection, right? The good news is you don't have to be a financial expert. Plenty of resources are available to help you. With a little effort, anyone can learn to evaluate a company. Section 3, patience. The investor's virtue. One of the most important qualities of a successful value investor is patience. The market can be irrational in the short term. Stock prices can fluctuate wildly based on news, speculation, and even just plain old emotion. But as Graham teaches us, the market is a voting machine in the short run and a weighing machine in the long run. Think of it like this. Imagine you own a small piece of a fantastic business. The business is profitable, it has great management, and it's growing steadily. But suddenly, some negative news comes out and the stock price drops. Do you panic and sell? No. You understand that the intrinsic value of the business hasn't changed. This is where patience comes in. You ride out the storm. You know that the market will eventually recognize the true value of the business, and when that happens, you'll be rewarded for your patience. Section 4, ignoring the noise. We're bombarded with information 24/7. Headlines about the latest market moves grab our attention. Graham observed, the investor's chief problem is himself. Emotions get the best of us. Fear and greed lead to poor decisions. We buy high in euphoria. We sell low in panic. Value investors should do the opposite. Tune out the noise, focus on fundamentals. Value investing is about being a contrarian, zig when others zag, buy when others are fearful, sell when others are greedy. This is how you find real opportunities. Now, let's talk about the market itself. Graham introduces us to a fictional character named Mr. Market. Imagine Mr. Market as your business partner, but with a bit of a split personality. Some days he's optimistic and excited about the future. He'll offer you a high price for your shares in the business. Other days, he's pessimistic and gloomy. He's convinced the sky is falling, and he'll try to sell you his shares for a bargain basement price. The key is to remember that Mr. Market is driven by emotions, not logic. He's like that friend who gets overly enthusiastic one minute and deeply depressed the next. Here's the thing, you don't have to listen to Mr. Market. He's there to serve you, not the other way around. You have the power to choose when you want to buy or sell. You don't have to react to his every mood swing. Think about a time when you made a decision based on your emotions rather than logic. Maybe you bought something you didn't need because it was on sale, or you said something you regretted because you were angry. We've all been there. Our emotions can cloud our judgment, especially when it comes to money. The same thing happens in the stock market. When prices are going up, we get greedy. We want to buy more, even if it means overpaying. We start to think the good times will never end. This is what leads to bubbles. We get caught up in the hype and lose sight of the fundamentals. And when the market crashes, fear takes over. We sell our investments at a loss, afraid of losing even more money. We convince ourselves that the world is ending and things will never get better. This is called panic selling, and it's one of the biggest mistakes investors make. Now, here's the good news. Mr. Market's mood swings can actually be your advantage. Remember, when he's feeling down, he's willing to sell you valuable assets at a discount. And when he's overly optimistic, you can sell him assets that have become overpriced. Think of it like this. Now, let's say your favorite coffee shop is having a buy one, get one free sale. Are you going to complain that coffee is too cheap? No. You're going to stock up while the deal is good. Value investors see market downturns as a buying opportunity. On the flip side, if someone offered to buy your used coffee maker for twice what you paid for it, wouldn't you sell it? Of course. The same principle applies to the stock market. When Mr. Market is feeling generous, you can sell your overvalued assets and lock in your profits. Section 5, don't get played. The key to profiting from Mr. Market's mood swings is to stay disciplined. You have to be able to control your emotions and stick to your investment plan. This is easier said than done, of course. But remember, you're not playing against the market. You're playing against yourself. One way to stay disciplined is to have a clear investment strategy. What are your financial goals? How much risk are you comfortable taking on? What kind of returns are you expecting? Once you have a plan, stick to it. Don't let Mr. Market's emotional roller coaster throw you off course. Another helpful tip is to diversify your portfolio. Don't put all your eggs in one basket. By investing in a variety of assets, you can reduce your risk and cushion your portfolio against market volatility. Section 6, the long game. Remember, investing is a marathon, not a sprint. It's about building wealth steadily over time, not getting rich quick. Mr. Market's short-term fluctuations are just noise. The real opportunities come from identifying undervalued assets and holding them for the long haul. Think of it like planting a tree. You wouldn't expect to see fruit overnight. It takes time for the tree to grow and mature. But with patience and care, you will eventually be rewarded with a bountiful harvest. Investing is the same way. So, the next time you see Mr. Market getting emotional, don't panic. Take a deep breath, remember the principles we've discussed, and make rational decisions based on your investment plan. In the long run, it's the intelligent investor who comes out ahead. Section 7, 2 roads to investment success. Now that we understand the importance of value investing and the fickle nature of Mr. Market, let's talk about you, the investor. Graham identifies 2 main types of investors, defensive and enterprising. Which one are you? The answer depends on your personality, your risk tolerance, and the amount of time you're willing to dedicate to managing your investments. Think of it like choosing a hiking trail. The defensive investor prefers a well-marked, leisurely path with scenic views along the way. They value safety and stability. They want a comfortable journey with minimal risk of getting lost. The enterprising investor, on the other hand, is drawn to the challenge of an unmarked, adventurous trail. They're not afraid to blaze their own path and are willing to navigate obstacles for the chance to discover hidden treasures. They're comfortable with more risk in pursuit of higher potential returns. Section 8, the defensive investor playing it safe. The defensive investor is all about preservation of capital. They prioritize safety and stability over high returns. They're content with earning a reasonable return without taking on unnecessary risk. This approach is ideal for those who are new to investing, have a lower risk tolerance, or simply prefer a more passive approach. Imagine a tortoise steadily making its way to its destination. It's not the fastest, but it's consistent and reliable. That's the defensive investor. They're not looking to get rich quick. They're playing the long game. They're building wealth gradually and securely, brick by brick. A defensive investor typically invests in a diversified portfolio of low-cost index funds or ETFs. They might hold a mix of stocks and bonds, adjusted according to their age and risk tolerance. They rebalance their portfolio regularly to maintain their desired asset allocation. Section 9, building a fortress of financial security. The defensive investor understands that time is their greatest ally. They're not trying to time the market or pick individual stocks. They know that over the long term, the stock market tends to go up, even with occasional dips and crashes along the way. They ride out the storms knowing that their portfolio is built to withstand market volatility. Think of it like building a house. The defensive investor starts with a strong foundation, carefully selecting quality materials that can withstand the test of time. They insulate themselves against risk by diversifying their investments and maintaining a long-term perspective. The defensive investor enjoys peace of mind knowing that their investments are working for them. Even while they're sleeping, they're free to focus on other important aspects of their lives knowing that their financial future is secure. Section 10, the enterprising investor seeking opportunity. The enterprising investor is a different breed. They're not content with average returns. They're willing to put in the time and effort to research individual stocks and uncover hidden gems in the market. They're not afraid to be contrarian, going against the crowd to find undervalued opportunities. Imagine a detective meticulously searching for clues, piecing together evidence to solve a mystery. That's the enterprising investor. They're constantly on the lookout for mispriced assets, companies that the market has overlooked or undervalued. They're willing to dig deep, analyze financial statements, and understand the intricacies of a business. This approach requires more time, effort, and a higher risk tolerance. The enterprising investor must be comfortable with the possibility of making mistakes and losing money in the short term. However, they're also driven by the potential for outsized returns, the thrill of finding that diamond in the rough. Section 11, navigating risk and reward. It's important to note that being an enterprising investor doesn't mean gambling with your money. Graham emphasizes the importance of thorough research, due diligence, and a margin of safety, even for the most adventurous investor. It's about calculated risks, not reckless speculation. Think of it like a mountain climber. They don't just start scaling a cliff without proper equipment, training, and a plan. They assess the risks, prepare for different scenarios, and make calculated decisions along the way. They understand the importance of safety measures and knowing their limits. The enterprising investor, like the mountain climber, understands that the higher you climb, the greater the risk. But they are also rewarded with breathtaking views and a sense of accomplishment that comes from conquering a challenge. They are constantly learning, adapting, and refining their strategies based on their experiences. Now let's talk about one of the most important concepts in Graham's investment philosophy, the margin of safety. Imagine you're building a bridge. You'd build in a margin of safety, extra strength to handle unexpected loads. That's exactly what the margin of safety is in investing. Your buffer against the unknown. It's the difference between what you estimate a company to be worth and the price you pay for it. The bigger the margin, the safer your investment. Calculating the margin of safety isn't just about crunching numbers. It's about understanding the qualitative aspects of a business as well. What makes this company special? What are its competitive advantages? How sustainable are its profits? Is management trustworthy and competent? Think of it like buying a used car. You wouldn't just look at the mileage and the year it was made, would you? You'd check the engine, the transmission, the brakes. You'd talk to the previous owner, ask about its history, and get a feel for its overall condition. Similarly, when evaluating a company, you need to look beyond the balance sheet. Read industry reports, analyze competitors, understand the company's culture and its management team's track record. The more you know, the better equipped you are to assess the risks and determine a suitable margin of safety. The beauty of the margin of safety is that it allows you to be wrong and still come out ahead. No one can predict the future with 100% accuracy. Even the most experienced investors make mistakes, but with a sufficient margin of safety, your investment can withstand those inevitable bumps in the road. Think of it like buying clothes on sale. You find a fantastic coat you love, but it's not on sale. You hesitate because you're not sure if it's worth the price. But then you find it marked down 50%. Suddenly it's a no-brainer. You buy it confidently, knowing you got a great deal. That's the power of the margin of safety. It allows you to buy great businesses at a discount, giving you a cushion against unforeseen challenges or errors in your analysis. It transforms investing from a gamble into a calculated decision, boosting your confidence and peace of mind. The margin of safety is especially crucial in today's world where uncertainty seems to be the only constant. We face geopolitical risks, economic downturns, technological disruptions, and unexpected events like pandemics. No one knows what the future holds, but we can prepare for it. Think of the margin of safety as your financial shock absorber. It cushions your portfolio against the unexpected, allowing you to navigate turbulent times with greater resilience. It's like wearing a seatbelt in a car. You hope you'll never need it, but you're grateful it's there if you do. In uncertain times, the margin of safety becomes your best friend. It allows you to sleep soundly at night, knowing that even if things don't go as planned, your investments are protected by a buffer of safety. It's the embodiment of Graham's timeless wisdom. The essence of investment management is the management of risks, not the management of returns. So, there you have it. We've journeyed through the heart of Benjamin Graham's The Intelligent Investor, a book Warren Buffett credits with his incredible success. Remember, this isn't about magic formulas or get-rich-quick schemes. It's about building a solid foundation for long-term financial well-being. We've explored the power of value investing, seeking out those hidden gems the market undervalues. We've met Mr. Market, that fickle character whose mood swings can be our advantage if we stay disciplined and focused on our long-term strategy. And we've learned to embrace the margin of safety, our crucial buffer against the inevitable uncertainties of the market. Think of these principles as the tools in your intelligent investor's toolkit. They empower you to approach the market with confidence, not fear. Remember, investing isn't just for the wealthy or the experts. It's for anyone who wants to take control of their financial future and build a brighter tomorrow. The most important step is to start. Don't let fear or procrastination hold you back. Begin by educating yourself. Read The Intelligent Investor, explore the resources available online and through your local library. Talk to financial advisors, but remember, you are the CEO of your financial life. Start small if you need to. The most important thing is to develop good habits, to think long-term, and to stay true to the principles we've discussed. Investing isn't about timing the market, it's about time in the market. The sooner you begin, the more time your investments have to grow and compound. Remember, financial freedom isn't just about having a lot of money, it's about having the choices and options that money provides. It's about living life on your own terms, pursuing your passions, and making a difference in the world. The journey starts today. Take that first step and claim the financial freedom you deserve.